Thanks, Christine, and good afternoon, good morning, and good evening, everyone. As mentioned by Christine, I will talk about that is at Standard Chartered Global Research, how we think the global economy would look like in next 12 months. We will have a special focus on Bangladesh and Euro area. Now, to start with, we can go to slide 1, Christine. I'm not sure if everyone can see Christine's screen and the slide pack. Can you see it?
Yes.
Okay, sure. So if we go to slide 2, as you can very clearly see, we expect global GDP growth at 4.8%. This is significantly higher than the last decade's average of 3.7%. There are two distinctive features about the growth forecast which we have for next 12 months. First of all, as you can see in the slide pack, Asia is expected to lead the recovery. And within Asia, of course, China and India are expected to grow at very robust rate. US and Europe are also expected to do much better in 2021 and also in 2022.
Anubhuti, let me just interrupt. Can I request Christina to actually move the slides? It's only the cover slide is being shown now.
Yes, slides are not visible.
Christine, can you move to the second slide, please?
There seems I have done so, but can you see the next slide or not? Otherwise, I would ask the admin team.
Sometimes happens with Zoom. Yeah.
Okay, Mrs. Stein, you have the presentation. It does not move on. Can you maybe show it? Because it does show the right slide on my screen. I'm very sorry for that.
No problem. These are the glitches. We are quite used to it. We can come back again. I think we cannot see the slides. Can you see the slides?
Let me try once again, but it did show correctly. Can you see it now?
No.
Few seconds.
Not exactly. I think some glitches, which is.
Can you see my slide, my screen, please?
Actually, he also has a copy. So if you Raki kindly put it on.
Can you see my screen, please?
Nobody.
Give few seconds. Few seconds.
Can I request you to share your screen? That will be better. Anubhuti,
that's what she's doing.
Okay.
I did that. So is it visible? Please let me know. Then I'll restart. Sorry for this whole inconvenience.
No, not at all.
It's taking a few seconds. Let's wait.
Okay, no problem.
I'm mute. Yeah,
maybe you want to talk through the slides. If it comes, it becomes visible. We'll see that.
That's a good point.
Yeah, why don't you start?
Go ahead with your
sure.
what you want to say.
Absolutely, I'll not waste time. Okay, so just to restart, we expect global growth in 2021 at 4.8%. This is significantly higher than the last decade's average of 3.7%. Now, our global growth outlook for 2021 has two distinctive features. First of all, it's led by Asian economies. So Asia is expected to grow at a much stronger pace relative to its 10-year average. And here, a lot of growth buoyancy is expected from China as well as India. US and Europe are also expected to do well both in 2021 and 2022, but not as robustly as Asia. And the reason is pretty clear. first been that Asian economies or emerging markets in general have benefited a lot from recent improvement in global trade. So I'm not sure if you're able to see the slide here. Global trade has rebounded at a much faster pace than global, in comparison to global financial crisis, and bulk of the benefits have flown to emerging economies. And we think that global trade will remain a supportive factor for emerging markets, including Asian economies in 2021, especially with the new US president. The other reason why we think Asia is likely to do better is because Asia has been, at least till now, I have to use that phrase, at least till now, has been able to manage the COVID situation far better than US and Europe. US and Europe are still struggling with high infection rates as we speak, and there is a risk of double-dip recession in Eurozone area, according to our view. We do expect an improvement in US and Europe, but we think that's likely to be a story of second half of 2021. And the growth improvement in both US and Europe in the second half of 2021 is likely to be extremely robust. This we expect because our view is that bulk of the population, both in US as well as in Europe, are likely to be vaccinated by the end of 2021, because they already have pre-existing arrangement with the vaccine manufacturers. And when compared to Asian economies or African economies, the size of their population is relatively small. So they will be able to vaccinate faster than Asian economies, and their growth are likely to pick up much better, but that's likely to come only in the second half of 2021. The second distinctive feature of our growth projection, that is of 4.8% in 2021, is that lot is a statistical rebound. Because 2020 was a bad year where most of the economies saw very deep recessionary trends, 2021 will see a rebound, but that's more a reflection of statistical rebound along with improving economic activity. The dead weight loss to global growth will take time to fade away in our view. What we mean by dead weight loss is that according to our estimates, what we have in slide 5 on the left-hand chart is that we believe that the global economy, after growing at 4.8% in 2021, will reach the same size as it was in December 2019. So by end of December 21, the size of the global economy will be same as it was in December 2019. Effectively, it implies 2 lost years for the world at large. And that's a massive loss. There will be few exceptions, no doubt about it. So China will be an exception. Bangladesh will also be an exception because these economies have been able to grow in the positive territory. But other economies like US will take longer, and Eurozone in fact reaches the same size of 2019 GDP only in 22, not even in 2021. So given the differential pace of recovery, given that the deadweight loss is pretty large, we expect policymakers across the world to remain supportive of nascent recovery. Moving to Eurozone, as I mentioned, we do expect growth to improve in both 2021 as well as in 2022. So these are our forecast, 4% in 21 and 3.7% in 2022. And we expect monetary policy and fiscal policy to remain supportive. But of course, within EU, there will be differential pace of recovery, amongst the countries. So countries like Germany will recover or are expected to recover at a faster pace because they are relatively less infected compared to, say, some other economies like, say, Spain, etc. And also they have few structural advantages in their favor. For instance, the household savings in Germany is pretty high. But overall, when we look at EU as a as a region, our sense is that growth will pick up from second half of 2021, but will take longer than US to completely fade away the dead weight loss. In contrast, Bangladesh was able to grow in the positive territory last year, and we also expect it to grow at 5.7%, so plus 5.7% for the year ending June 2021. For next year, we expect it to grow at plus 7%. So extremely impressive numbers, especially when you compare it to other economies. And a lot of growth support or faster revival has come because it is hugely household consumption expenditure driven. Its net exports also was supportive, along with very strong remittances inflow. And I think when we compare Bangladesh to other economies, especially in the South Asian space, say India, Bangladesh entered this pandemic on a stronger footing. So it has been able to cope up much better. And we believe that the recovery will be decent over the next 12 to 24 months. Having said that, when you compare Bangladesh's growth since FY20 till say FY22, it will still be lower than what Bangladesh achieved 3 years before the pandemic, which was an average of 7.7%. So there is some bit of loss because of the pandemic, but nevertheless, Bangladesh will still emerge as one of the outperformers amongst the Asian economies. We remain extremely constructive on Bangladesh over medium term. And the way it has coped up well during the pandemic year, we continue to remain extremely constructive. Having said that, I think it's important to remember, and this was also referred in the initial remarks, the world, we are still not out of woods. There is a vaccine, but we still need to look at the path and remain cautious of the path, which will finally lead us to an end of the pandemic. We are still far away from that. Even after the pandemic ends, the world will be left highly leveraged, both the corporates and the government. And protectionism, even with the new president, is unlikely to go away. Thus, it becomes extremely important for all countries, including Bangladesh, to prepare for a different normal over the next few decades. And in this regard, we believe that Bangladesh needs to diversify its exports basket, as well as diversify probably its export destination too. Currently, almost 60% of its exports are headed to Europe. Another odd 20% heads to US, and almost 90% of exports to EU are textiles. So there is a heavy concentration, in the export basket as well as the destination of exports, and there is a need to diversify both. This becomes extremely crucial if we just stretch our horizon from next 12 to 24 months towards a decade, because Bangladesh will be graduating from the LDC or least developed country level. And our sense is that it will be phased out from international support measures from 2027. Once that happens, there will be a gradual withdrawal of GSP, which in turn can lead to higher tariffs of around 6 to 7% for most of the Bangladeshi exports, 12% if those exports are headed to EU. There can be challenges around concessional finance, and also, the export basket can also come under some pressure. Hence, it becomes imperative for Bangladesh, in our view, to negotiate preferential treatment either with international organization or a GSP with the EU. Obviously, Bangladesh will also have to work on other areas to boost macroeconomic stability and quality of governance, like any other economy. And given the LDC graduation, this becomes very urgent, because the GSP is likely to be phased out in this decade itself. Based on a 2019 survey, Bangladesh is considered as the third most, it's the third most preferred destination for companies who are looking to shift out of China. So manufacturing shifting out of China, obviously Vietnam and Cambodia are the top two, and Bangladesh is the third most preferred destination. There is a lot of potential, and in order to translate this interest into actual FDI, more measures will be required to improve the ease of doing business, because the ease of doing business and net FDI inflow in any country, there is a clear positive correlation. As it improves, we see higher FDI inflows. So in a nutshell, I would say that the economic relationship between Bangladesh and EU has worked very well. In fact, Bangladesh has been one of the few economies which did exceedingly well despite the pandemic, and we remain constructive on the future outlook. However, this is the time to consolidate, but at the same time to prepare for a better future, and to hope that the next few decades are as shining as the previous decade was. With that, I'll take a pause and pass it on to Christine. Thank you.
Thank you very much, Anubhuti. And I'm just checking, can you keep sharing your screen and showing my presentation, or does the Zoom host, Ragbig Hassan, want to do it? Anubhuti, if you have a chance, then that would be much appreciated. If not, I can go ahead and we'll do the same as earlier. If the slides come up, it's great. If not, I will depict it with my hands. So as we have heard from Anubhuti, there are various reasons to be very positive and to keep investing post-COVID as well. But there's also challenges at the horizon, inter alia through the graduation from NLDC, which namely could actually represent a potential loss of access to concessional finance, right? This together with the situation where we say positively keep investing, and on the other hand, well, we need financing to invest in that capex, that brings the ECA, or the structured export finance, to light, exactly, and exactly what Mark mentioned and alluded to before. So if I may just quickly, ECA, as Mark said earlier, stands for Export Credit Agency, and for the German exporters, this export promoting agency would be called Euler Hermes. So in basically what it does, it is a financing that is there to finance a commercial contract that your good company would be negotiating with an equipment manufacturer, in our case from Germany. And the positive advantage of it is that the bank that will be happy to provide that financing will be in a situation to offer longer terms and better terms than if it didn't benefit from a guarantee. I'll show that in the next slide, but for the moment, from your perspective, so your esteemed company perspective, why think about an ECA financing as an alternative CapEx financing? We've said there is the background will be a CapEx requirement, be it for growing your business or be it just for switching production due to change trends, be it from COVID or from other mega trends out there. Thanks to the guarantee which I will outline earlier, the all-in, so meaning the margin as well as the premium cost that will be spread over the margin. So the all-in cost shall always be very competitive for your company compared with other sources available. I think one of the, to me, clearest advantages is the long tenors that can be offered. So namely, it is the construction period or the delivery period, however you want to call it, with repayment tenors of up to 14 years, depending on the sector. I would say very generally would be 10 years, depending on the sector, 14 years, and for very special sectors such as renewable projects, it can go up to 18 years. Those financings are available in most of the freely convertible currencies. And I think the second strongest advantage that I would like to show your companies is the fact that this financing is structured in a way that it shall match the cash flows of your project from the beginning to the end, meaning that you will have drawdowns available as the deliveries and as the partial commissionings work, thus reducing negative carry that you might have with other financing sources that you could have tapped for it, and the amortizing nature of the repayment schedule will, which actually only starts 6 months after the commissioning of your new plant or your new production facility, right? Also naturally match the cash flows of your project. So to me, this is really one of the strongest arguments why it is definitely worth thinking about it as an alternative financing source for your CapEx. And last but not least, it is, it represents a diversification to your regular funding sources. Thank you very much, Anup. If you could just go to the next slide. So, and this is just to have it brought to light, the typical buyer's credit financing structure. So what do we mean by buyer's credit financing structure? If you look at the yellow box, it says borrower/buyer. So as I was saying, this financing is tied to a commercial contract. It's there to make a commercial contract happen. So if we start looking at it, there is, your company would be the buyer of some, capital, of some production equipment. And number one, that we see there, it will be negotiations around a commercial contract with a supplier. And the supplier will hear in 2 minutes from here. One example is Oerlikon. So, and to make this project happen, and from the idea of the export credit agencies, which, are a capital goods export promotional tool, once there is a negotiation, the ECA will look at it and will say, yeah, this is eligible for a cover. So we will be happy to provide a cover to the bank, which is in our example Standard Chartered, to the bank that will give you a long-term loan to finance it. So this is how the structure, this chart or this graph is to be read. So number two, you have a cover available for this export that will happen, which is export of capital goods from Germany to Bangladesh. The cover is there, hence giving Standard Chartered the opportunity to conclude an ECA-backed loan with you, and in this case, your company would then be the borrower, right? And this is a specific 85% of the commercial contract. That is an OECD consensus rule that says, yes, we want to promote and we want to finance commercial contracts, but we can do so up to 85% of the commercial contract. We expect the buyer to come up with a down payment by its own means, or we as a bank can offer you a commercial loan, which will have a slightly shorter tenor for the 15% remaining down payment financing. in the interest of time, I will, I will leave the cash flows out, because what we want to do today is to match it all with the topic of post-COVID economic relations between Bangladesh and Germany, and to make the structure, the theoretical structure, very tangible. I had asked Mr. Panek from a market-leading equipment provider to co-present with me so that we can speak about a true the project that is actually happening, and what the drivers behind are there. Mr. Panek, if I may leave the floor to you.